Today we'll be taking a look at Warren Buffett's 1999 letter to shareholders, in which the Oracle of Omaha begins on a downer. Up to that point, 1999 was the worst performance year Berkshire Hathaway has ever had with Warren Buffett at the helm. We had the worst absolute performance of my tenure, and compared to the S&P, the worst relative performance as well. Relative results are what concerns us. Over time, bad relative numbers will produce unsatisfactory absolute results. Now, what factors contributed to making 1999 the worst year, performance-wise, for Warren Buffett? 1999 was a euphoric year for the dot-com boom, with the Nasdaq climbing from under 2,200 at the beginning of 1999 to surpassing 4,000 by the end of 1999, a gain of over 85% for the year. The Nasdaq's 85.6% yearly return for 1999 sets the record for annual return for any major indices in investment history. Investors around the world clamored for over 300 technology IPOs that launched that year, including CarsDirect.com, which raised $280 million, and Webvan, the online delivery grocery store whose IPO stock rose 65% on its first day of trading, which valued the company at around $8 billion. Lots of people were making money in the ramp-up of the dot-com boom. Stories would surface of college kids who made a fortune day trading technology stocks, or college tech whiz who were managing large tech-based hedge funds with millions in invested capital. Warren Buffett wasn't one of those investors making money hand over fist during the dot-com boom. He didn't understand the inner workings of technology companies like CarsDirect.com and Webvan. In his own words, our problem, which we can't solve by studying up, is that we have no insights in which participants in the tech field possesses a truly durable competitive advantage. Warren Buffett wasn't with it. He was stuck investing in old stodgy companies like Coca-Cola, Kraft Heinz, and Walmart, stocks that the investment community all but forgotten in the dot-com boom. Many in the media speculated that the legendary Oracle of Omaha has lost his touch, that he was from a bygone era, a relic of finance's past. The dot-com era was a new age in economic prosperity that promised to rocket the economic projection of the country upwards and beyond. But with hindsight, we know that in the year 2000, the dot-com boom became the dot-com bust, with the Nasdaq declining over 75% before bottoming out in 2001. It would be 15 years before the Nasdaq returned to its height it achieved in the dot-com boom. The Oracle of Omaha was vindicated in his decision to not invest in technology companies that he did not understand how they operated or what their competitive advantages was. Regardless of the fact that Warren Buffett is worth billions and is consistently ranked in the top 5 richest people in the world, he understood that there were certain things that he was good at and understands, and certain things he isn't good at and doesn't understand. If we have a strength, it is in recognizing when we are operating well within our circle of competency and when we are approaching the perimeter. Predicting the long-term economics of companies that operate in fast-changing industries is simply far beyond our perimeter. We just stick with what we understand. Psychologically, it's easy to get caught up in the herd mentality, especially when you're watching your coworker or neighbor get rich quickly. It must have been incredibly tough to tune out the media, family, and friends who were all chatting about the latest and hottest technology IPO that launched recently. To hear them boast about the money they made so far investing in Pets.com or some other newfangled tech IPO while you're stuck with Costco stock. It requires mental fortitude to admit that you don't understand something, that you have no idea how X technology company can be valued so high or how Y technology company can ever generate a profit. It's much easier to listen to others, especially well-dressed pundits on TV who justify and rationalize the ever-increasing PE ratio or non-existent PE ratio because the company's never made any money. It's always difficult to be a contrarian, to go against the grain while everybody else around you is getting rich. But to be successful in investing in individual companies, you must recognize your limitations. No one can know everything. The pool of investment opportunities is simply too large for one person to grasp it all. As Warren puts it, our lack of tech insights, we should add, does not distress us. After all, there are a great many business areas in which Charlie and I have no special capital allocation expertise. For instance, we bring nothing to the table when it comes to evaluating patents, manufacturing processes, or geological prospects, so we simply don't get into judgments in those fields. Warren Buffett understood the laws of investing, which gave him the strength to stand by his investing convictions. We see the growth in corporate profits as largely tied to the business done in the country, GDP. If profits do indeed grow along with GDP at about 5% rate, the valuation placed on American business is unlikely to climb by much more than that. If investors' expectations become more realistic, and they almost certainly will, the market adjustment is apt to be severe, particularly in sectors in which speculation has been concentrated. Warren Buffett has since gone on to make several large investments in technology companies. More than $12 billion in IBM, $19 billion in Apple, and $1 billion in VeriSign. However, even these technology companies are the old stewards of technology companies. It's not difficult to analyze Apple's core competency and competitive advantages. Thanks for watching. I hope you learned something from Warren Buffett's annual letter to shareholders. Please consider subscribing, as it's a great free way to support the channel so I can bring you more investment advice from legendary investors. Till next time.